Great. So now we know what subtotals and totals in a financial statement are, and we also know how to calculate year-on-year growth. This is already a good start that will ease our work. The next thing we'll mention are financial statement formats. When we talk about different formats, we mean different ways to arrange the items inside the balance sheet and the income statement. Please remember that there is no rule regulating how to organize the formats of financial statements. What is important is to remain consistent with names and definitions, and to use a format that describes the business under consideration well. For example, for some businesses, it may be more appropriate to use an income statement format that shows a gross profit subtotal that is given by revenues minus cost of goods sold. Other businesses, on the other hand, may not use this format and will directly show operating profit, also known as EBIT, and so on. The decision is up to the company's management and should be taken in a way that best represents the underlying business. A popular balance sheet format is the one grouping assets and liabilities according to their maturity, current and non-current. However, there are also some other formats. Analysts often organize the balance sheets that they are using by separating operating from non-operating assets and liabilities. Now, let's suppose that we've chosen the correct format, and we are ready to start carrying out our analysis. There are two main types of analysis that we can perform: horizontal and vertical. Horizontal analysis represents the comparison of historical financial information over a series of reporting periods. The main idea is to see if any numbers are unusually high or low with respect to the information about previous periods. For example, we can wonder how much the total revenues increased in percentage compared to the ones observed a year ago. Horizontal analysis is also known as trend analysis because it shows the development of a given parameter over time. On the other hand, vertical analysis involves the numbers from the same accounting period. Each item is divided into a specified base, which is the 100% figure. In the balance sheet, this base is usually the value of total assets, while in the income statement, this is the total revenues figure. As you can see in this example, the gross profit, operating income, and net income are divided by total revenues, which allows us to understand what percentage of revenues they represent. Then, once we've done that, we can compare these figures with the company's peers or with its historical data and make observations that are based on the development of its financials. So, now that we know about different income statement and balance sheet formats and about horizontal and vertical analysis, we are ready to delve into another interesting topic: ratio analysis.